First of all, take a look at the returns of these mutual funds. These are all returns from just the last 1 year. All of these are the annual returns for the SEBI registered Indian mutual funds. Some are funds from the DSP BlackRock Group. Some are from Nippon India or ICICI or Axis. This means all of them are major players. They can be trusted. In fact, this one fund has delivered a return of more than 235% in 1 year. That means it turned 1 lakh into more than 3,35,000. But until now, these funds were hidden from retail investors. But don't worry, today I'll also tell you which mutual funds these are. And I will also discuss other mutual funds that could easily outperform the market, just like this in the near future. And most importantly, I will provide a simple breakdown of how you can invest in these specific funds whenever you desire. These 4 funds have truly given outstanding returns. I mean, while a normal investor gets happy with a 20 to 25% return, these funds have given 100, 150, even more than 200% returns, and they might continue to do so in the future. Why? Because these funds fuel critical semiconductors, plus artificial intelligence, precious metals, and advanced technology. Today, I'm going to tell you about 10 mutual funds that have given truly outstanding returns to investors in the last 1 year. The first fund is my favorite, not because it gave a return of 108% in 1 year, but because for the singular reason that this particular fund I will mention invests in the world's largest mining and metal companies. These are all companies whose business is producing iron ore, copper, gold, aluminum, zinc, and nickel. Nifty over the last year yielded almost flat to negative returns. But this fund has completely won me over because this is a fund from the DSP group, which has been active for about the last 13 years. Started in the year 2013, the fund has a 36 rupee NAV and also its current AUM is around 171 crore. The expense ratio is 1.60% and risk is very high. This is because it follows the direction of the commodity cycle. When the direction is favorable, it generates returns. Otherwise, the fund is flat. The NAV can also fall. This fund is not a core holding for your portfolio, but it can have an allocation of 5 to 10% in your total portfolio. It is the DSP World Mining Overseas Equity Omni FOF. Note down the fund's name. But wait a minute, don't rush to invest directly. Because I am definitely going to tell you about 9 more funds, one of which happens to be a newly launched fund. It's an NFO where the unit price is simply 10 rupees. And its CAGR for the last 3 years is over 58%. So first, do one thing. You should watch the entire video to understand all of these funds. And afterwards, I will explain everything regarding where and how to invest. And yes, before you go on investing, I'll also explain the rules for investing in these global funds so you don't make a wrong decision. Because often, when you try to invest, you'll encounter an error. But there is a simple solution for that as well, which I will discuss later. Just give me 10 minutes of your valuable time today, and I will explain everything clearly. Now let's move to the next fund. It has given a return of 86.68% in 1 year, and this fund could truly be the future of India. No, not just India's, but actually the future of the entire world. Because this fund operates in a completely different sector, clean energy. Solar, wind, hydroelectric, EV charging, smart grids, everything is covered in this single fund. Crude oil prices are skyrocketing. In this scenario, every country is shifting its energy sources towards renewable energy. Because of this particular reason, you must have seen many solar stocks skyrocket over the past few years. And this fund's underlying companies are actually America's largest renewable energy companies. The fund is called DSP Global Clean Energy Overseas Equity Omni FOF. NAV is 32 rupees. The AUM is 104 crore with an expense ratio of 1.72% for direct plans. This fund has an ESG driven portfolio. Essentially, this means it excludes any companies that fail to meet environmental standards. Consequently, the fund returns might appear slightly conservative when compared against pure play mining stock performers. However, the portfolio quality is always high. Most of the time, it consists of blue chip companies. If you want to invest, say, a sum of just 2,000 rupees per month in an emerging global megatrend, then clean energy becomes a truly serious investment consideration. However, do not invest blindly, because even better opportunities are approaching. The next fund is from Axis Mutual Fund, which has delivered a return of 66.92% in the last 1 year. This specific fund is currently the biggest direct play on the China recovery story that is available to Indian retail investors today. Alibaba, Tencent, BYD, CATL. These are all the kinds of companies that have benefited greatly from Beijing's stimulus package in 2024 and 25. They directly benefited from the property sector's stabilization and the push for AI. In 2024, Goldman Sachs called the Chinese equity market the most undervalued large market, and those who invested there saw their money grow by 66%. It holds a 13 rupee NAV and 3,000 crore AUM. It holds the single largest AUM among all the funds on this list, which indicates that significant institutional money is already flowing in. The expense ratio is just 0.40%. It's the cheapest international fund, and the minimum SIP starts at just 100 rupees. This means even retail investors like you and me can invest here. The fund's name is Axis Greater China Equity FOF. If there is truly anyone who can compete with the United States in technology and AI, it is only China. And you can easily invest in China through a SEBI regulated route. This specific fund is a fantastic consideration, but the risk is high, so please invest very carefully. Now, let's cover the most important part. Whenever you invest in a stock or mutual fund, your money is invested through a specific route. This fuels the growth of the entire capital market, and the next fund does exactly that. It fuels this whole growth story. It's a new fund offer with an NAV of just 10 rupees per unit, a fund that participates in every mutual fund, broking company, stock exchange, and also wealth management companies' overall market growth. Whenever you decide to purchase a stock, start an SIP, or invest in an IPO, some financial company in the world earns money from each one of those individual transactions. BSE, MCX, HDFC, AMC, Angel One, and CDSL. All of these organizations I mentioned facilitate your investments and also make money from them. So it's simple. If investing in India continues to grow, these companies will grow as well. In just the past 10 years, India's mutual fund AUM has surged exponentially from 10 lakh crore to 76 lakh crore rupees today. That's a growth of almost 7 times. What's more, SIP flows have increased from 43,000 crore to 3.5 lakh crore annually. Currently, India's mutual fund penetration is only 20% of the GDP, while the global average stands at 64%. This clearly means the real growth story has only just begun to unfold. And if you truly want to directly benefit from this entire growth, the Axis Nifty Capital Market Index Fund is the absolute best option. This particular fund actually covers capital market cornerstones like BSE, MCX, HDFC, AMC, CDSL, and Angel One. These are companies that directly benefit from every investment activity in India. Whether the market goes up or down, their consistent earnings continue to flow in. The Nifty Capital Markets Total Return Index has delivered a positive return of 17.75% in just the last month. Plus, it has posted an annualized return of 31.9% over 5 years. While the Nifty 500 gave a return of only 12% in the same period. The NFO for the Axis Nifty Capital Market Index Fund opens May 4th through May 15th, 2026 with a minimum investment of 100 rupees. Yes, remember one thing. This is a thematic fund, which means it's a high-risk fund. It is for those people who are truly prepared for long-term wealth creation. By the way, this isn't a recommendation, but I personally feel this fund is a good one. The next fund's special feature is that it's not confined to a single sector. It's a hybrid play. On one hand, you have critical metals needed for the EV revolution, like copper, lithium, uranium, cobalt, aluminum, and so on. On the other hand, there are traditional oil and gas giants like ExxonMobil, Chevron Corporation, ConocoPhillips, Shell, and Total Energies. So this combination has been created deliberately, based on the assumption that the entire world is undergoing an energy transition, which is true. While new fuels are currently emerging, these older fuels will certainly remain critically important for the next 5 to 10 years. This lets you capture returns from both sides. Over 1 year, the fund has yielded 78.16% gains. And the most interesting part is that among all the funds on this list, its expense ratio is very low, just 0.53% for the direct plan. This means more of your money is put to work and less goes into the fund house's pocket. The fund's name is ICICI, Prudential Strategic Metal and Energy Equity, FOF. If you want to make money from the energy sector in the future, then this global fund is a good option. This fund is ideal for investors who don't want to place a single thematic bet and want to cover the entire spectrum of the energy transition, without needing to decide if the future of energy is green or if oil remains relevant. The fund handles this balance itself. Over time, they will continue to change their holdings. But still, remember, this fund falls into the very high risk category. Because commodity prices are volatile, you've already witnessed the volatility in crude oil prices. It has delivered exceptional returns in 1 year, but there's no guarantee that this will be repeated in the future. Now let's talk about the one mutual fund that has literally broken all previous records. This fund generated a return of 237% in 1 year. It turned 1 lakh rupees into about 3,35,000 rupees. If you had invested, you'd probably be very happy today. And this is not just about the fund. It is actually about an entire geopolitical and technological megatrend. Taiwan produces more than 60% of the world's advanced semiconductors. TSMC, Taiwan Semiconductor Manufacturing Company, is actually the primary company where Apple's M series chips and Nvidia's AI GPU chips are currently manufactured. AMD processors are manufactured there too. This shows the sophisticated AI chips inside all the mobile phones, laptops, or any other electronic gadgets you use today are being produced right here. As the AI boom peaked and giants like OpenAI, Google, Meta, and Amazon invested hundreds of billions in infrastructure, that's when TSMC and its supply chain companies showed unbelievable growth. This fund has successfully tapped into that very supply chain. It directly holds the stocks of various companies listed on the Taiwan Stock Exchange. The expense ratio is just 0.86% and the AUM is over 600 crore. It is the Nippon India Taiwan Equity Fund with NAV around 37 rupees. Note this. If you want to invest in the semiconductor sector and take a thematic bet, this fund is a fantastic choice. This fund is for investors who are convinced that the AI and semiconductor revolution is only just getting started. And for individuals who want to invest in the foundational hardware backbone of that technological revolution, this fund is an option that is absolutely worth considering. But let me give you a reminder as well. The geopolitical risk in Taiwan is real. Semiconductor stocks are inherently cyclical. The 237% return in the last year was exceptional, so it would be a mistake to make this a core holding. You might enter at a high point and then get stuck. You can treat this as a high conviction thematic satellite bet, allocating only 5 to 10% of your total portfolio here. Doing it in a disciplined SIP format would definitely be best. You can hold it with patience for the long term, watching it grow. This fund will definitely benefit, directly or indirectly, from the growth of the semiconductor and AI sectors. The next fund on our list has delivered a return of 83.29%, that too in just 1 year, and no one is even talking about it. This fund invests in 5 emerging economies simultaneously: China, India, Brazil, South Korea, and Indonesia, through the specific JP Morgan flagship Emerging Market Opportunities Fund. This means you gain JP Morgan's research, JP Morgan's fund managers, and JP Morgan's global network, all for an SIP of just 100 rupees. This fund's NAV is only 31 rupees. This means for the price of a cup of tea and a snack, you can co-own dominant stocks in 5 growing economies. Just think about it. By investing in a fund with an NAV of just 30 rupees, you can start investing in 5 different countries. The AUM is around 188 crore. The expense ratio is only 0.56%, but the risk is very high. Why? Because emerging markets are volatile. Currency risk is also a real factor. However, the long-term growth potential can also be significant. The fund's name is Edelweiss Emerging Markets Opportunities Equity Offshore Fund. But of all the mutual funds we've discussed today, only the Axis Nifty Capital Market Index Fund is an Indian fund with focus on India. All the others provide you with global exposure. Investment is restricted in some of these global funds, while it's allowed in others. For example, investment is allowed in the Edelweiss Emerging Markets Opportunities Equity Offshore Fund. Investment is also allowed in the Axis Greater China Equity FOF. But as soon as you log into your broker's mobile app and decide to try and invest in the Nippon India Taiwan Equity Fund, or perhaps the DSP World Mining Overseas Equity Omni FOF, you will discover that you are unable to successfully complete the investment. You will suddenly start receiving an investment suspended error message. But the real question is, why exactly are Indian investors not currently allowed to invest freely in global mutual funds? Are these funds just risky? Or does the government not trust foreign markets? Well, actually the reality here is truly something else entirely. Many investors in India think the Indian government is stopping them from investing abroad. Well, that's not true. India has imposed an overall limit on overseas investments made through mutual funds. This means that the entire Indian mutual fund industry can only invest a certain total amount in foreign markets. This limit is fixed by the RBI and SEBI regulatory bodies. Back in 2021 and 22, as the Nasdaq craze was booming, investors started aggressively pouring capital into global mutual funds. But do you know what exactly happened as a result? The entire industry had almost reached its total overseas investment limit. And subsequently, the AMCs were forced to suspend all new investment activity. It became impossible to make any fresh investments, neither as a lump sum nor through an SIP. Even those who had ongoing SIP faced restrictions. In this situation, everyone's investment goals were disrupted. Some funds were suspended completely. Now, the question is, why doesn't the RBI increase the limit? See, when Indians invest in global funds, rupees are converted into dollars, which then flow out of the country. If an excessive amount of capital starts flowing out of India in this manner, the value of the rupee will decline even further. And this will put pressure, directly or indirectly, on our domestic economy. As an investor, you might make money. But when India needs to import goods, they will actually become more expensive. It can also put pressure on our forex reserves, and currency volatility can increase. That is precisely why the RBI wants to keep capital outflow in check. It is very important to understand that this restriction does not mean global mutual funds are bad. In fact, diversifying your investments globally can be a very smart strategy. Because when the Indian markets are not performing, you can still generate returns from global markets. There are many growth opportunities available outside of India as well. Additionally, you get currency diversification, and you can indirectly acquire exposure to major global giants such as Apple, Nvidia, and Microsoft. So the issue isn't with the funds themselves, but with India's overseas investment limit. And if the RBI increases this limit in the future, these restrictions might be removed. Until then, investors will just have to invest according to the available headroom and strict AMC rules. However, I actually have a clever way for you to legally bypass this current limit. You can invest in these large global funds and also become a shareholder in the biggest companies around the world. To learn more, check this video. in which I've discussed 10 such Indian and global ETFs that deliver high returns and have explained the process to invest in them. I repeat, it's 100% legal, government approved, and compliant method. I have provided the direct link to that video in the description box below, so be sure to check it out if you want to invest in any of the biggest ETFs globally, or if you want to invest in any of the largest companies. You might face restrictions with mutual funds, but direct investment in ETFs is allowed. And yes, I've put additional details for all the funds discussed in this video in the description. Before making any investment decision, please be sure to do your own research. And you should definitely consult your financial advisor. Most of these are high-risk funds, so thorough research is really essential before investing. Jai Hind.